Hello and welcome to Capturing Growth. Really want to continue on with our macroeconomic theme around the whole sort of synchronized global growth story and why at the moment healthcare and the health space remains probably one of the more lucrative areas in the growth area. The reason for that, as I've explained before, is that not only do they get to pick up from organic growth from the actual economics that's going on in global markets, but they also get it from the fact they have consistent underlying capital flowing into it. This week, I want to compare it to energy. And the reason for that, clearly in a growth market, clearly when you've got places like China, Europe, the US, etc., really ramping up on their growth profile and gross domestic product moving to levels we haven't seen probably in about 5 to 6 years, even as far back as the GFC for places like Europe. Energy is one area you'd expect to actually see ramp up. The catch at the moment with traditional energy, and I'm talking about oil and gas here rather than new world, things like batteries and renewables, is that the oil price is still very heavily regulated and very much influenced by geopolitical issues on the supply side. OPEC continues to be at war with itself and unable to really drive that price back towards its 5-year average that it wants to. We know it's frozen supply, it's been doing this for the last 3 years. However, the battles inside the OPEC cartel remain a big problem for it. And if you look at Saudi Arabia, Iran, Iraq, and to some extent Qatar, the abilities for those 4 nations out of the 15 sort of countries that make up OPEC just hasn't been able to gel. The other catch to it is that although they are cutting supply and trying to push the price up, non-OPEC nations, places like Norway, Canada, the US and Brazil, actually soak up price as they push up supply from the OPEC side. It's a really interesting conundrum, and you can see this very clearly in the EIA data that comes out of the US. Every time the US barrels has gone above $60 a barrel, it means the EIA has seen a massive jump up in rig utilization. Suggests very clearly that US companies and US firms are soaking up price when it jumps above that. When it drops below, you see the EIA on the rig count numbers drop right off. And that clearly means that supply is capping out any form of upside you may get from the economic output of the growth scenario we have. That's when we look at health, and that's why, again, it's quite an interesting conundrum to be looking at. Let's compare health on the US side. We've done it with Australia. The reason I want to do it with the US is that 25% of the consumption of oil in the world is done by the US. So I think it's a fairly good way to compete and actually to have a look at some sort of translation. Currently, the national health expenditure of US consumers in the US is sitting at about 3.3 trillion US dollars. That's just shy of 16% of total GDP. By 2026, it is expected to ramp up to $5.7 trillion, which will be almost 19% of US GDP. That is a staggering amount of capital flowing through health markets. If you look at the returns that US healthcares have returned, last year it was about just shy of 16.5%, and on a long run average of 5 years, it's 14.5%. Compare that to US energy plays. Last year they were down 2.88%, and over the 5-year average, it's roughly the same amount. It shows very clearly the cyclicality in oil also means that you sort of lose out on that side. Health, therefore, with that kind of expenditure coming through, with the fact that you've seen particularly things like prescriptions now making up almost 62 billion US dollars per quarter, the kind of expenditure, the kind of revenue, and the kind of growth that goes into US health looks much more sort of translative and also much more attractive. The only caveat that I'd point out is that there is very much some short-term downside, and it's come from geopolitical risk. And the catch in the US at the moment is clearly the current administration, and President Trump has several times over the last couple of months said things that have certainly caused a bit of rupture. But what I would say, with the kind of money going in, the expectations around growth for 2018 through 20, the public expenditure going into 2026, health looks a much more better prospect than energy.